Hi there. Welcome to the continuing series called Money Matters by the Olderhood Group. And my guest today is Ian Price, who is a renowned financial consultant based in the United Kingdom. Hi, Ian. How are you doing today?
Bill, I love the word renowned. I was called elderly the other day, so I like the word renowned. So that's much better.
Well, it was kind of renowned or re-owned or something like that. So I thought maybe I'll stick with the renowned sort of thing. Yeah, and I thought today we're getting a lot of interest in interest rates, if I can use that sort of pun. We get a lot of people talking about interest rates, through some of the other stuff that we do, both in person and social media, whatever. And we still seem to be in a climate of increasing interest rates. They're still rising.
Mhm.
And, it's funny because, when you talk to younger people, they sort of have, an opinion, an outlook on how does it impact them. You talk to older people, it seems to be slightly different. So can I put you on the spot here and say, tell me what you feel is the impact of continuing rising interest rates on, let's start with younger people.
Bill, I think a really topical area. I think with youngsters, you and I can remember a lot. We can go back. If you think from 2008, 2009, basically around the world, we've had what you could argue is unrealistically low interest rates. So we grew up in high interest rates, high inflation. So we're aware of interest rates. But from 2008 up until probably, about 18, 19 months ago, you had such low interest rates that nobody ever thought they could go up so quickly as to what they've done. Okay, I'm very UK just at the minute, but UK's had about 15 interest rates over the last 18 months and is now trading around about 5% when it was trading at 0.1%. So youngsters or younger people are in a different position to older people. So younger people have got debt, usually a mortgage of some description to purchase a house. So they're seeing a significant increase in the cost of borrowing, which is impacting their net spendable income. So I think that's the biggest issue about suddenly, and the figure I've got in the back of my mind, about 1.4 million people in the UK are coming off fixed rate mortgages this year, have seen a significant erosion in their net spendable income as interest rates go up.
And of course, that equally applies to things like car loans and stuff like that.
Yes.
Over any type of borrowing, as you say. Do you feel that it holds people back from actually borrowing? I need a new car, and I don't have the money to buy it outright. I'm going to have to go to the bank, sort of thing, and get a loan. Do you think that holds people back?
No, in a funny sort of way. That sounds really weird. I think if you think about how it today, most people lease a car or do a private. They don't actually physically purchase the car. They almost have a lease deal. At the end of the day, the car manufacturers are very, very clever at positioning. You can lease this car for either £300 a month or $300 a month. So they make the cost relatively easy rather than actually physically going out and buying the car. So you've seen a phenomenal change. So I think what youngsters are doing is having to review what they call their fixed costs and making decisions on what is luxury and what isn't luxury. And I think there's a change in that. So when we had very high interest rates, we didn't have a lot of luxury items on top of that, including silly things like, for instance, broadband, mobile phone. So they're having to reassess their income and how they spend that income. I think that's what they're doing.
Let me take you back to the mortgage issue because you're right. Most people, that would be their biggest expense. So their accommodation costs, whether it's rent or whether it's mortgage, and I think rents are, impacted by increasing interest rates, etc., by the, landlords and all that kind of stuff. But let me go back to the mortgage issue. Okay. From a banking perspective, I know you're not a banker, but I'm going to put you on the spot again. From a banking perspective, when a person or a couple or whoever it is comes in and says, look, we've saved up X number of dollars or pounds, we'd like to buy a house, here's the kind of house we'd like to buy, tell us what the deal is, sort of thing. And the bank says, well, if you want an X number of years mortgage, 10, 15, 20, 25, 30, whatever that number is, the monthly cost is going to be X and Y, principal and interest. Okay. Do you think that because interest rates are rising and therefore the balance between the principal and interest obviously, goes out of equilibrium, sort of thing, does that impact the lending side of the deal? In other words, do they say, look, we're having a look at your financial statements, your current income, current expenses, etc. But frankly, and I don't want to put words in the mouth here, but frankly, we don't think you can afford it. In other words, you maybe can afford the principal plus interest, but the balance between principal and interest is going the wrong way for you. I mean, does the lender look at that kind of thing?
Yes, and it's quite personal at the minute, which I'll explain just a second. I think the key thing is, one is, I'm sure there's people who'll be listening to this who could be quite worried about coming off a fixed term bill and worried like, oh my God, what's going to happen, etc. One has to take it and put it realistically. Lenders do not want people not to they don't want to foreclose, do they? They'll do anything. So what we're seeing in the UK, for instance, is suddenly if you're coming off a low interest rate, you're on a fixed one to a more high interest rate, sometimes they'll extend the term, sometimes they'll even go on interest only, which is, as you know, Bill, is you literally are just borrowing the money. At some point, you pay the capital off. Now, I have to be honest, I only ever had an interest-only mortgage in my life. I used other assets to pay my mortgage off. So you are seeing stress testing is becoming really interesting. And this is an old man looking in, hilarious. So my daughter is just gone through this process of moving. I had to, and this is honest to God, true story. They did the underwriting and she was £265 short, right? I had to sign a letter to say that I give my daughter £265 and I wouldn't take a charge on the house. That is how stupid some of this system has got. Does that make sense, Bill? You've got almost unrealistic, to sign a letter like that, absolutely ridiculous. But there's no point arguing because that's what the lender wanted. The lenders are really stress testing, but I am nervous that some people could be coming off fixed rates where they might have fixed it, say, 1%, to go to 6%. It's a 5% interest rate. Which is, grandmother suck eggs, but every $100,000, pounds you borrow, that's costing you another $5,000 a year. It's going to push people, but that's why the lenders will work with them to do something about that, Bill. So I think you're absolutely right, and it's a very interesting environment because I don't know about you, Bill. I'm not sure there isn't another rate rise coming around the corner.
Yeah, I knew you would nail it. Stress testing. I love that. You're absolutely correct. I mean, that's exactly what it is. Does that trickle down though into the situation where first-time borrowers, obviously the numbers can swing around. I understand that, but I mean, is it possible for the lender just to simply say, no, look, I'm sorry, you just ain't going to get it because we just don't think you can afford this?
Yeah, Bill, yes, and that's impacting the market. There's a recent article came out. I'm going to use a lovely term we've used before, Bill, called BOMAD, the Bank of Mum and Dad. In the UK, that is a significant factor in the housing market because the Bank of Mum and Dad are helping out. I'm aware of talking to some financial advisors in the UK. They've seen a significant increase in people accessing investments and cashing them to actually pass to their children to reduce the mortgage so they can afford it. So it's a bit of a circle going on at the minute, Bill, that's impacting the market. So I'm called BOMAD, the Bank of Mum and Dad. Actually, we've never shut, really, if I'm honest. We just help out when we can. I think that's significant, and that's going to impact some thought process about inherited wealth that people keep going, there's a tsunami, quote, unquote, of money that's going to go from the baby boomers to the next generation. I don't think there is. I think that's happening here and now, Bill. So the market is being distorted by baby boomers helping their children today, given the economic climate we're in.
Yeah, and just to be clear, there's also a branch of the Bank of Mum and Dad out here in Bermuda as well. So just
Yes.
just want to be clear about. I just want to be clear about that. I want to go into the older folks in 1 second, but let me just finish off the younger thing with the other side of the coin. In other words, from the savings perspective, there's rising interest rates for the younger person. Does that appeal? Because I mean, obviously, savings accounts, etc., have been fairly low over the last several years, as you mentioned. But is there an increase in savings and using bank type savings accounts because the interest going up?
I think the good thing is, Bill, we would always talk to anybody of any age about having what's called sometimes rainy day money, i.e. money that you might need to access. There's a lot of discussions, we could spend hours talking about how much, but let's say it's either 3 months or 6 months income. It doesn't really matter where. Whereas before you didn't used to worry about it. Well, now actually you can get interest on that money. So, what I'm very concerned about at the minute is there's a lot of people with cash who aren't actually benefiting from the high interest rates because they're leaving it in current accounts, for example, rather than savings account. So even for the youngsters, the rainy day money starts to work for them, because we would argue, unless you're going to invest in the market for 5 years plus, why invest in the market? Save it in cash. So there's some good things about higher interest rates, which is you get monies on savings. It's the yin and the yang. We're just about to look at the other side of that, which is older people. So youngsters should be making sure that they put their cash into the highest rate savings account. I've just seen one in the UK. National Savings are offering 6% for 1 year. That's not insignificant. Does that make sense? Whereas, we would have spoken 2 years ago and we would almost just, don't worry about cash, can get 0.2, 0.3. So suddenly you've got to start thinking smarter in all age groups.
All right, let's move up the age scale here into a wee bit more familiar territory for you and me. Let's go into the older folks area. Let's look at the mortgage side of things, because you've just raised a couple of very interesting points there, because you talk about inheritance and wealth and property values and so on and so forth on the one hand, but then on the other hand, as you get older, you are looking at your savings, your portfolio, whether it's in stocks, bonds, whatever that may be. Let's take a swing at the mortgage side of things for the older folks first.
Right, cool. I have to be, I speak from a personal point of view. I'm in a very, very lucky position. I haven't got a mortgage, which is one of my key financial objectives, was to make sure by the time I got to my age, I didn't have a mortgage. Right. If you've still got a mortgage and you're older, basically you're going to be paying more money for it. It's simple and as straightforward as that. What we are starting to see is, mortgages being pushed out irrespective of the age now, because it just is. So even if it's twofold. If you're more mature, that's a lovely way of putting it, not old, but more mature, you can either you've got a mortgage, okay, you've got to work out what you're going to do. Two, you're going to start, if you haven't got a mortgage, this can be good news. Can I go back to people with mortgages? What I think some people might consider doing, if they've got a mortgage, they might decide, you know what, given the higher interest rate, is it now time to downsize to get rid of the mortgage? Does it make sense to make we've had a discussion, Bill, about the fixation on property, absolute fixation on property. But let's say you've got a place worth, I don't know, $750,000 or £750,000, and you've got a £200,000 mortgage. Why don't you just move and buy one for £500,000, and suddenly your net income is going to go up dramatically. So I think people will be making that decision if they've got a mortgage. If like me, I'm very lucky. I've just been around to my in-laws. Since I've seen you, Bill, we haven't seen a couple of months. My mother is still now 99 and a half, getting very close to 100. Honestly, this is good news for them because they've got money in the bank. Suddenly, at their age, they don't need to get capital growth. Suddenly getting a 6% return is a significant increase in their income. So there's always, we talk about yin and yang. This is a real yang.
Yeah. I mean, there's no question about that. What you lose in the swings, you gain in the roundabouts, basically, yes, as we always used to say.
Yeah.
I mean, I think you're right. The whole thing about the property portfolio, basically your own house. I mean, you may have other homes or houses, I understand, but that situation, particularly when you bring in inheritance and so on and so forth, is a long conversation. I'm sure we'll come back to that, in future episodes. Let me switch you then over to like stocks and bonds, obviously. So interest rates go up, bond values come down, so therefore my wealth, so to speak, the portfolio, the balance of my portfolio, the value is going to be coming down. Am I concerned?
I think we've had this conversation before in a different way. A couple of things to mention. One, you only have to worry about two prices: the price you buy at and the price you sell at. If your price you sell at is going down and you need to sell, it's an issue. If you look at the yield, and that's the key thing you're getting, that's important. So I own some stocks at the minute where the capital value has come down significantly, but the yield is still good. Does that make sense? You mix things around. So I don't need to sell those stocks. So the yield is okay. I think what I'm seeing a little bit, and I think I would definitely check it, is we have something whereby you can give your capital away to get something called an annuity, okay, which is a guaranteed income for life. As interest rates go up, annuity rates go up. And there might be a point where you decide to move some of your portfolio to give you guaranteed income for the rest of your life. Why? Because the rates are starting to look attractive. And I think as you get older, your appetite for risk does diminish a bit. So let's say, I don't know, let's say you're 70 and you might be able to get, say, a 7 or 8% annuity. You might want to think about that. But what you've rightly said, what's that stock worth that you sell to buy it is a discussion to have, but you should review it. But I do get worried that people go, it's gone down. No, keep clear. Two things. Capital growth and income are two different things. Your capital might go down, but your yield is still quite attractive. So the yield on those stocks is probably around 5-6%. I'm quite relaxed. I don't need to sell those stocks. So I think that's clear.
Yeah, that takes us in again. You and I have talked about this, and we've talked about this in our seminars, webinars, and all that kind of stuff. Is that when you get into the older age group sort of thing, you're much more concerned about what we call sustainable income.
Spot on.
Sustainable income is the key. That's what you're aiming for. Now, I'm not disregarding inheritance and estates. No. I'm not disregarding that. I'm simply saying, for the older person or couple, whatever, to live, they need income. They need cash. Cash is king in retirement. Fine. So you're bang on correct there when you're saying that don't worry too much about the capital value going downwards, as long as the yield is going to stick in there 4, 5, 6, 7%, whatever that may be.
Absolutely right. And I'm passionate. One of my friends, they've decided what they're going to do is sell their house. It's a reasonably nice house. And at some point, when the kids need it, to help them buy houses. And they're considering downsizing and releasing 50% of the equity to give 25% to each child. There's so much going on. But also, can I just say, this is UK specific just for a second, Bill? We have something called a state pension over here, as you know. Actually, state pension looks like it's going up by 8.5% next year. So there's a real interesting dynamic going on in the marketplace. And this isn't for today, Bill, but it probably sets up for another one about the gap between the older and the youngsters, how it's all panning out. And, so older people getting more increase, and some of them definitely need it, but it's fascinating to watch that. But yes, you mustn't mix things up about value versus income. And that's really important to me. About one of the things you mentioned that I'm very conscious, we talk about house owners. We are seeing in the UK, particularly at the minute, rents going up. Because guess what? The cost of borrowing means that landlords are getting out of having properties. Therefore, supply and demand, there's less rental properties. Therefore, the rent's going up. And that's an issue. If I'm really honest, Bill, that's a big issue going forward for society. Not for us to solve, but it's definitely happening at the minute in the UK.
Yeah, I think we've opened up a Pandora's box with this with this topic. Right. I think what we'll do is we'll revisit this, in future episodes, Ian, because I mean, I don't want to belittle the whole point about rising interest rates or
No.
decreasing interest. I don't want to belittle it in the sense of saying, well, it's just something in the past. Oh, rates are going up, but so what? Oh, no, 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 no. I think it is a critical component of life as we know it. Doesn't matter whether you're 25 or 45 or 75, doesn't matter. I don't know. I just seem to get that feeling that people sort of say, oh, well, just one of these things. Yeah, it's cost me more. So what? Move on. But it's got so much ripple effect that I think a lot of people just sort of that I don't want to say they ignore it, but they kind of, well, it'll come right one of these days. Maybe it will. So I'm thinking that we want to come back to this, again, and perhaps we do want to split it a little bit more into, one episode about young and one episode about older, because as you correctly say, that sort of, as I call it, the ripple effect is extraordinarily important. So anyway, any last comments?
Yes, just want probably put this in context. I agree with you. What the UK have been using is using interest rates to reduce inflation. The problem is there's so many people on fixed rates, it's not having the effect quickly. And that's the big issue. And I totally agree with you, Bill. We must, I met somebody this week, their mortgage has gone up by £750 net a month. That's huge. That is absolutely huge. So you're quite right. We should never belittle it. And I think sometimes politicians sometimes do, because they don't actually realise what does it mean for this person or that person, Bill.
In fact, my state pension over here just last night, in fact, has gone up by $54 a month.
Yeah.
So that's gone up. So that basically, given inflation or whatever sort of thing, that allows me to now buy 2 tins of Campbell's soup every week, as opposed to the one that was previously. All right, listen, Ian, thanks a million. Great conversation. Yeah, we'll come back on this. So that's it, folks. You've been listening and watching, hopefully, to Ian Price, who is a financial consultant in the UK, and this continuing series of Money Matters by Olderhood. We'll see you again. Take care, everyone. Thanks. Bye.
Thank you.